Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you look at energy fuels, the picture that really emerges is a company in the middle of a profound shift.
A shift away from just being a uranium company.
Exactly. They're aggressively moving from being, a niche uranium miner into something much, much bigger, a broad critical minerals processor. That diversification is really the core of their entire story.
Okay, so let's unpack that, because that sounds like their strategic moat. And it all seems to center on one kind of irreplaceable asset, the White Mesa Mill in Utah.
It does.
This isn't just a processing plant, is it? It's the only conventional uranium mill operating in the entire United States.
That's the key. And when you think about the regulatory hurdles, the permitting, just the sheer cost to build one of those from scratch today.
It's almost impossible.
It's an incredible, almost insurmountable barrier to entry for any new competitor.
Right.
And that unique asset isn't just for uranium anymore. It's the physical foundation for this whole diversification play. They're targeting three very strategic commodities.
What, sure?
Uranium, of course. Then rare earth elements, we call them REEs, and heavy mineral sands, or HMS.
So it's a three-pronged approach. That seems smart. It hedges them against, the price swings of just one market.
It's incredibly intelligent. It gives them leverage into multiple global supply chains, all tied into decarbonization and defense.
And on the REE side, this is where it gets really interesting technically, right? Because they've had a pretty big breakthrough.
A huge one. They successfully produced high-purity dysprosium oxide at pilot scale, right there at White Mesa.
And dysprosium isn't just any rare earth. It's a heavy REE, which is notoriously difficult to separate. Their chemical properties are all so similar.
Exactly. So what this milestone does is it validates their technical capability in the hardest part of the whole process, the separation. Lots of companies can dig ore out of the ground. Very few can turn it into the high-purity oxides that manufacturers actually need.
And those oxides go into, what, EV motors?
EV motors, wind turbines,
Mm-hmm.
advanced defense systems, things that need incredibly powerful permanent magnets. So by proving they can make it here domestically, they instantly become a very, very serious player.
Which connects directly to the whole geopolitical situation. I mean, being a domestic U.S. supplier of uranium and these heavy rare earths, that's got to benefit from all the talk about reshoring critical supply chains.
Oh, absolutely. The political tailwinds are completely behind them. Everyone is focused on moving production away from foreign control, especially with, all the concern over potential export restrictions from China, which just dominates the market right now.
So the government isn't just cheering from the sidelines.
No, they're providing concrete backing. It de-risks the whole thing and reinforces how strategically important this company is becoming.
Okay, so they have the asset, they have the political winds at their back. The next question is always money. How do you fund this massive expansion?
Well, they just pulled off a major financial win. They raised $700 million in convertible senior notes.
Wow.
But here's the really eye-popping part. The coupon rate on those notes is an incredibly low 0.75%.
0.75%. In this environment, that speaks volumes.
It really does. It shows you the level of institutional confidence in their long-term story. I mean, the market is basically treating this like a pre-IPO tech financing, not a junior miner. The net proceeds, about $674 million, are all earmarked for growth.
And where's that money going specifically?
It's all about expansion. A big chunk is for the Phase 2 rare earth separation circuit at White Mesa. That's what takes them from a successful pilot to commercial scale.
Okay.
The rest is going into developing their new heavy mineral sands projects, especially the Donald project in Australia. That's a key source for the REE feedstock they'll be processing in Utah.
All right, so let's tackle the common bear argument head on, which is always about current profitability. You look at the numbers, and historically, they've been loss-making.
Right, and you have to put that in context. When you're in a massive multi-year build-out like this, you have to invest heavily in capital expenditure. That's just part of the model. It means you're going to have negative earnings and cash flow at first.
You have to distinguish between growing pains and, a failing business.
Precisely. And it's worth noting, we did see a little flash of potential profitability recently. Some numbers showed a positive net income of $1.9 million and $8.2 million in free cash flow in the first quarter of 2025.
So it's volatile.
It's a hallmark of this transformation. They're not optimizing for quarterly profits right now. They're building future revenue streams.
And that $700 million raise gives them a huge buffer. It's a runway to execute without having to worry about going back to the markets if there's a delay.
Liquidity is freedom in this sector, absolutely.
Let's drill down now on what I think is their deepest moat, which is the uranium and HLEU business. You mentioned they're the only U.S. company licensed to produce HLEU at commercial scale.
Correct. That's a regulatory and infrastructure advantage that is just extremely difficult for anyone to replicate.
So for listeners who aren't specialists, what exactly is HLEU and why is that high assay part so critical?
It's a great question. So standard reactor fuel, or LEU, is enriched up to about 5%. HALEU high-assay low-enriched uranium is enriched to between 5 and 20%.
And why does that higher enrichment matter so much?
Because it's mission critical for the next generation of advanced nuclear reactors. We're talking about the small modular reactors, the SMRs, from companies like NuScale and TerraPower. HALEU is more energy dense, so the reactors can be smaller, run more efficiently, and need refueling less often. It makes them way more cost-effective and flexible. Without a domestic HLEU supply, the entire U.S. plan for advanced nuclear kind of stalls.
And the government is clearly not going to let that happen. Is there concrete support there?
There is. They've already received a $12 million grant from the Department of Energy, specifically to expand HALEU throughput by 60% by late 2025. And they've secured contract extensions with 3 new DOE-qualified fuel vendors. So they're locking in that future demand.
And all this is happening while the general uranium price is pretty strong.
Incredibly strong. It's been around the mid-80s per pound recently. That improves the economics of their entire U.S. uranium portfolio and boosts the value of the inventory they're holding. It gives them real flexibility.
So looking ahead, what should investors be watching for, say, over the next 3 months, between December 25 and February 26? What are the big catalysts?
I'd put them in a couple of categories. First, you've got the scheduled stuff, the Q4 earnings release in late February. Investors will be looking for confirmation they beat their production guidance, but more importantly, for updates on the REE commercialization timeline. That phase 2 expansion is key.
Right, and beyond the earnings report.
You have the market-driven events. Quarterly ETF rebalancing happens in December, and then you get the big institutional 13F filings in January and February.
Which can drive a lot of volume.
A ton. The ETF rebalancing can force funds to buy shares, and the 13Fs will show if, big pension funds or asset managers have taken new positions, which is a huge vote of confidence.
Okay, then there's the third category, the more speculative stuff. What are the rumors floating around?
There's a lot of chatter about new U.S. government contracts to support domestic uranium supply. A guaranteed contract from the DOE would be massive.
I can imagine. What else?
Second, there are these persistent but unconfirmed reports about takeover interest from a larger resource company. Which makes sense, right? A mining major might see buying them as the fastest way to get a critical minerals foothold in the U.S.
That's a good point. A buy versus build strategy.
Exactly. And the last one is the potential for a large, long-term supply contract directly with the utility, particularly for that specialized HALEU fuel or for the rare earth oxides. If any one of those 3 things hits, the stock could move significantly.
And analysts seem to be betting on this execution. The growth outlook looks pretty strong.
It's very optimistic.
Yep.
Models are forecasting a huge revenue rebound in 2026, something like 85% growth, and a big improvement toward profitability. They see the EPS loss narrowing to maybe around -6 cents.
Now we have to talk about risk. For a story this complex, with so many moving parts, what's the single biggest risk an investor has to watch?
It is pure execution, plain and simple. They're trying to ramp up uranium, expand the REE circuit, and develop new mineral sands projects in Australia all at the same time.
That is a lot to juggle.
It's a massive undertaking. Any major delay, technical problem, or cost overrun on any one of those projects could really shake investor confidence.
What about the valuation? That's another point critics bring up. The price-to-sales multiple is high, something like 46 times.
It is. It's an astronomical multiple for a traditional materials company. It means the market is already pricing in future growth that hasn't happened yet. You usually see numbers like that on a speculative tech stock.
So the market is valuing it based on its potential, not its current earnings.
Exactly. The counterpoint is that this premium reflects its scarcity value. There's no one else who has an operating U.S. uranium mill and de-risked heavy RE separation capability. That unique combination justifies it for some.
But it also means it's volatile.
Extremely. The stock has a high beta, over 2. So if the whole critical minerals sector goes up 10%, this stock is likely to go up over 20%. But that sword cuts both ways. It's a highly leveraged bet on the entire ecosystem. So to kind of wrap it up, what Energy Fuels offers is this really unique leverage. You're combining the tailwinds of the global uranium sector with a first-mover advantage in the U.S. heavy rare earth supply chain.
All backed by a ton of new capital and government interest.
Right. The next 1 to 2 years are just absolutely critical for them to execute and make this transformation from a niche miner into a real diversified powerhouse.
A fascinating story.
And maybe the provocative thought to leave you with is this. They're juggling 3 very different, very specialized balls in the air: uranium, rare earth chemical separation, and mineral sands mining. Which one of those do you think presents the biggest opportunity for a surprise upside, and which one carries the highest risk of derailing the whole story?
That's it for today's analysis. If you found this discussion valuable, make sure you subscribe to the podcast to catch our next analysis.